Google's Steve Jobs, WeWork's Adam Neumann, Uber's Travis Kalanick. What do all of these business leaders have in common? They are all CEOs who were fired from their own companies. It turns out that no one is invincible in front of investors and board members, and keeping the stakeholders happy can call for quite a bit of finessing. There's a reason why Berkshire Hathaway's shareholder meeting is referred to as the Woodstock for capitalists. To keep investors happy, the company goes as far as providing discounted shopping and exclusive celebratory events at these meetings. At the end of the day, even someone as revered as Warren Buffett works for his investors. Okay, let's get into it. Investor relations, or IR for short, holds the key to a company's future. While business management is often associated with a whole lot of number crunching, its human-facing side is more of an art form. Follow along as we dive into the landscape of IR, how it came to be important, how it operates, and what investors like to hear in this day and age. We will also present contrasting case studies from Exxon to NVIDIA to show how good and bad IR practices can impact a company's fate. At its core, the goal of IR is to convey a company's financial results and operational strategy effectively to its financial stakeholders. Healthy investor relations operates as a two-way communication channel, not only giving information to stakeholders, but then also relaying stakeholder feedback to upper management. So, what kind of communication is expected from the company to keep its investors happy? Companies usually use a combination of press releases, financial reports, conferences, and presentations to keep investors informed. Since there needs to be consistency in those updates, most companies opt for a quarterly and also an annual investor report. These reports are often presented in front of board members, but can also be accessed online too. Broadly speaking, investor reports present two types of information: the numbers and then the story behind the numbers. Certain components are always expected, namely the financial statements, but investor confidence and satisfaction has to do with more than just the financial performance. As Warren Buffett once put it, there should be an intent behind the report. Like, one should be able to paint a picture of the company's priorities beyond just the cold, hard accounting numbers. And that's where MDNA, or Management's Discussion and Analysis, comes in. MDNA reviews the company's business operations, its trends, risks, and future prospects. This enables management to provide its view of the business, explaining the story behind the numbers. So, what are some reporting tips that companies employ to tell a favorable story and make investors happy? We'll start with the ones that are tried and true, and then move on to the ones that have been increasingly popular in recent years. First up is consistent financial performance, which essentially is the most foolproof way to investors' hearts. Because when companies consistently meet or exceed financial targets, investors get to happily harvest steady, predictable returns on their investments. Like Microsoft, for instance. It may be past its heyday, but its successful transition into a cloud-based business model continues to drive a steadily rising share price. Leadership and culture. Investors look for companies that are well managed, and also with strong governance practices, ethical conduct, and a culture of transparency and accountability. Changes in the management team, or board of directors, can sometimes signal big shifts in a company's overall strategy. Warren Buffett once said, "I like to know as much as I can about the person that's running and how they think about the business." It's literally no surprise that Adam Neumann was ousted from WeWork with his excessive spending and industry lifestyle. Industry backdrop. Warren Buffett has just one more thing to say about outside information. "I can't understand how my company is doing unless I understand what the other 8 are doing." A good understanding of the company's industry and its main competitors demonstrates the company's awareness of market dynamics, its ability to adapt to changes, and its competitive advantage. Essentially, it instills investor confidence by showcasing a clear understanding of the company's positioning and its strategies to navigate challenges, but also capitalize on opportunities. Growth mindset. Companies that invest in new products, technologies, or markets can offer exciting growth opportunities for investors. Since technology progresses faster and faster over time, it's literally crucial for companies to be on the forefront of early adoption. Of course, the caveat is growth initiatives that need to be assessed first to ensure worthwhile return. Google's parent company Alphabet is known for investing in a wide range of new technologies and markets, from self-driving cars to healthcare. And while they haven't always been successful investments, they represent potential new sources of growth. And with growth, eventually comes new revenue streams for the company. Crises and risk management. Though risk management is not a new topic in business, it's become more important in recent years as the world underwent public health and political upheavals. When the COVID-19 pandemic hit, Intel quickly implemented measures to protect its employees and ensure continuity of its operations, which essentially allowed it to continue delivering products to customers without significant hiccups. While, on the other hand, many other companies suffered from major supply chain disruptions. ESG, or environmental, social, and governance factors, are increasingly important to investors. Companies that demonstrate a commitment to sustainability and social responsibility and cultural inclusivity are more likely to have a favorable reputation among customers, which translates into better business and higher investor confidence. In May 2021, the oil and gas giant ExxonMobil faced a significant challenge from a small activist hedge fund, Engine No. 1, which owned a tiny fraction of Exxon's stock. Despite its small size, Engine No. 1 was able to gain the support of much larger institutional investors, including some of the biggest pension funds in the US. Investors were upset over Exxon's insufficient response to climate change and the transition to clean energy. They argued that this puts the company at risk for long-term financial decline. In a huge victory for Engine No. 1, 3 of its 4 nominated candidates were elected to Exxon's board at the company's annual shareholder meeting in May 2021. This outcome was seen as a major rebuke to Exxon's leadership and a sign of growing investor concern about ESG, which poses long-term strategic issues rather than concerns over short-term financial performance. Stakeholder capitalism. The concept of stakeholder capitalism is gaining traction and fast. Instead of focusing only on the major shareholders, stakeholder capitalism considers the interests of all stakeholder types, including employees, customers, and communities. The practice usually requires that a broader range of issues are discussed in addition to the traditional business topics. Executive compensation. Investors are increasingly focused on executive compensation, especially the link between pay and performance. Companies will need to be more transparent about their compensation policies and how they align with company performance and shareholder interests. Okay, so get this. In 2020, the CEO of Norwegian Cruise Line Holdings was awarded $36.4 million in compensation, an increase of over 20% from the previous year, even though the company reported a net loss of $4 billion for the year due to the pandemic, and furloughed a significant number of employees in the process. Yikes. This led to backlash from shareholders, and the company's executive pay plan was rejected at the annual meeting in May 2021 as a strong message of disapproval from shareholders. It later became part of a broader trend of say-on-pay votes against executive compensation packages at several companies in 2021. I mean, just check out these numbers and you'll see why. Despite the examples of bad investor relations I've mentioned so far, some companies actually have demonstrated success in that arena. Let's take a look at NVIDIA, a major player in the ongoing chip war. Known for its graphics processing units, NVIDIA found a new market opportunity in AI and data centers due to the applicability of their technology in these fields. This marked a pretty significant strategic shift from primarily focusing on gaming hardware. CEO Jensen Huang and his executive team actively communicated this strategic shift to investors and analysts. More importantly, Huang, known for his in-depth keynote presentations, has a knack for breaking down complex technology subjects to make them more accessible to stakeholders and ultimately easier to understand. As NVIDIA won buy-ins from investors, it was able to successfully execute its growth strategy to become a major player in data centers and AI, which had since started to contribute significantly to its revenue and stock price. The company's market cap is now among the highest in the semiconductor industry. Throughout its history, the field of investor relations has evolved in response to changes in technology, regulatory requirements, and market conditions. What began as simple communication with investors has grown into this complex discipline that plays a crucial role in modern capital markets. While strategies may vary, The fundamental principles of transparency, regular communication, and demonstrable commitment to the shareholders' interest remains the same. And if you're an investor yourself, it's worth researching different companies' playbooks to understand how the information they choose to present shapes your perspectives and decision making. Have you ever heard of any success or failure stories when it comes to investor relations? Or if you're someone who works in investor relations, what are some new trends or demands that you're seeing? Leave us a comment so we can learn together. Thank you so much for watching.